All right.
Thank you for joining our webinar today. I'm Corey Walters, an associate professor here at the Center for Ag Profitability at the University of Nebraska. Remember to find an archive of past webinars, as well as a schedule of upcoming webinars in our Thursday series on our website at cap.unl.edu. The 2023 deadline for purchasing Pasture, Rangeland, and Forage Insurance, otherwise known as PRF, is December 1st. Today's webinar will explain how PRF insurance works and key characteristics that producers need to understand. We'll see examples of how PRF can be used to cover feed costs during a drought, and as well as analysis of average payouts up to date. PRF is a useful insurance product that should be thought of in a multi-year game, not a single year. Presenting today, we are pleased to have Dr. Jennifer Ifft, Flinchbaugh Agricultural Policy Chair and Associate Professor at Kansas State University. Dr. Ifft, thank you for joining us.
Thank you so much for having me, and thanks for everybody for joining us. The goals I have for this talk, first of all, is to help make sure everybody has an understanding of the basic characteristics of PRF, or what the important characteristics are. I'll also point out a few items that if this is something a producer is interested in, they would need to do some more work on or talk to an agent about. I'm also going to provide some examples for how big PRF payouts have been in Kansas by drought status of particular counties. And I'm also going to look at the magnitude of PRF and LFP payments relative to forage costs to see how these payments are helping producers today manage the ongoing drought. So before I get started, I wanted to see if we could use the chat function to see what everybody's familiarity is with PRF. There's some places where I could spend a little bit more time or go a little faster, depending on experience. So just sort of, I'd like everybody to think, are you inexperienced with PRF? Do you not know very much about it? So you do low, medium, or high. So low is you don't know much about it. Medium is you know a few things. High would be you've used it before, you've sold it, you're very comfortable with it. And if everybody wouldn't mind just using the chat box to say, you can either describe it or just go with low, medium, or high to give me an idea where everyone's at. Okay. All right. Okay. So just looking at the initial responses, thank you everyone so much for sharing. It looks like we have people with a wide range of experiences, and hopefully I can provide something that is valuable to everybody. We are going to start out, however, with sort of a broadly thinking about the safety net for agriculture. I am a professor of agricultural policy, and this is a perspective I'm coming at this with. We talked a lot about the federal farm safety net. The basic idea of this is the public or the taxpayer shares in some of the risk of agricultural production as it relates to natural disasters or market risk or price risk. Historically, the safety net is focused on crops, but there's a lot of products that do cover cattle as well. Some of these are through the federal safety net program, others are through the Farm Service Agency or FSA programs. So there are safety net products that can cover production risk. These are mainly FSA programs. You could think of funding for blizzards. If you had calf loss during late spring blizzards, for wildfires, there's programs for that. Technically, the federal crop insurance could cover production loss through whole farm revenue protection or microinsurance as well. There's feed risk as well. This is what the topic of this, PRF, Pasture, Rangeland, and Forage Insurance. There's also some FSA programs that cover feed risk. price risk as well. And again, there's crop insurance products, livestock risk protection that can protect cattle producers against price risk. So there are a wide range of products out there, but they haven't been around or as favorable as the products for crop producers. The federal crop insurance program is well established for row crops. So if you grow corn, wheat, soybeans, for most people, this is just an annual business decision that you make, something that you've done for a long time. You're buying insurance from a private insurance agent, but it is a public-private partnership, and the federal government is covering part of the cost of that. So in essence, it's designed so the producer comes out ahead. We'll get more into that. Again, there are some products that are out there to help, livestock products, and most of these have only come out or been widely used in the past decade or 2 decades. There's a lot of reasons for insuring. Basically, you're protecting your business or your family against things that you can't control. I always say everybody manages risk. So a lot of producers will say they self-insure. However, there is potentially a cost to that, whether you have to keep a larger savings account, you can't invest as much, or through off-farm work. Also, some producers, you want to expand your herd, you want to make investments. Lenders really like insurance. So sometimes insurance is a requirement to protect yourself, protect your investments. The last point, federal options are becoming more favorable.
Sorry. Were you wanting to share some slides? I think you had some slides.
Are my slides not being shared?
No, we can't see them.
Oh, shoot. Thanks.
You're welcome.
I've been going through them. There we go. Thank you, Corey. All right. You see them?
Yes.
Okay. This is much better with slides. All right. So I think another reason for insuring today, a lot of people are thinking about is just there's a lot of uncertainty in the world. We were talking about PRF, extreme weather, the ongoing drought that we have in the plains. I know in Kansas, we have 50 counties and except the highest level of drought right now. A lot of other volatility in the world today as well. So what does insurance do? It replaces lost income. It makes you whole. So if you have an unexpected loss, it's going to cover some of that. What this allows a business to do is make decisions based on currently available information. So say you know your crop yields, or you know how many cows you could typically support on your pasture, or how much hay you typically get. So it allows you to make decisions based on that. This insurance protects against unexpected losses. So you can go ahead and make decisions based on what you know today. So with crop insurance or livestock insurance, like anything, there are some new terms, a different language. The 2 ones that I want folks that maybe have less experience with insurance to be aware of are coverage level and then your guarantee or liabilities. So coverage level, you can think of it, it's the inverse of a deductible. It decides how bad things have to be for you to get a payment or an indemnity. So how much of a loss do you have before insurance starts making up for those losses? The guarantee or liability, that's the value of what you're protecting. So that's how much of how big or small of a payment you're going to get is based upon. So you could compare PRF or other crop insurance products to regular insurance. So here I have a table that looks at forage insurance versus regular insurance. So what forage insurance or PRF is protecting against is lower precipitation or lower than usual rainfall. That's not a rare event, especially out here. Think about car insurance. it's more covering against rare or unlikely events. So if you want to think about it, like you hope that you don't get in a car accident as much as a drought is experienced in the plains, or as much as there's low rainfall. In terms of the cost for PRF or forage insurance and other insurance products is shared with the federal government. So producers don't pay the full cost. They might be paying only half of the cost. For car insurance, typically you're going to pay the full cost out of pocket. And you're going to pay it right away. So when you buy an insurance policy, it's going to be billed fairly soon after you sign up for it or at the beginning of your coverage period. Whereas for forage insurance, you don't pay until, well, it's September for calendar year 23. So it's about 8 months after the beginning of coverage. So again, it does work like your car insurance in some ways. You have a loss, it's going to make up for some of the cost of that. But in a lot of other ways, it's different. We'll get into that. So when I teach agricultural policy, I ask my students, what's the yield for livestock or what's the yield for forage, to help them think about why livestock insurance products are the way they are. And they give pretty good answers. Bales of hay produced, tonnage, which makes sense. However, measuring forage yields is tricky. Producers don't always do it. And also the quantity of forage doesn't always translate into a high quality of forage. So measurements of yield aren't as consistent as for crops. The same concept applies to livestock as well. Because of this, for insurance products, they rely on indices, they're index insurance products. So PRF, it's precipitation or rainfall index. We're going to get into the details of that shortly. Other livestock insurance products might use futures markets for that index. So now to get into the details of pasture, rangeland, and forage insurance. So if you had to summarize it into a tweet, if there's one thing you need to know, this is it. And we're going to break this down, but it's, if you have pasture hay and it's drier than usual in your area, you get paid. So that's basically what it is. It might seem like there's a lot of details with insurance, there usually are, but you're getting paid when it's drier than usual in your area. That's what it is. So the first part, you have to have pasture or hay acreage. So these could be perennial hay crops that you're growing. Could also be pasture or rangeland that's used for grazing. So that's the main requirement for eligibility. You also have to have drier conditions than usual. This terminology is very intentional. A lot of times we say rainfall or drought insurance with PRF because those are terms that are more familiar. But technically, what it does cover is lower precipitation than usual. So this could be snowfall as well as rain. So it's not just about rainfall, although with precipitation, it often is. The next part is area. So PRF covers lower precipitation than usual in your area. So it's not based on what happens in a particular field or in a particular farm. It's based on what happens in a particular grid. So what's the precipitation in a grid relative to the historic average? I pulled this grid here. This is Jefferson County, Nebraska. I'm from Fairbury, Illinois, so I picked Fairbury, Nebraska. That was the only reason for this particular part of Nebraska. But this is what a grid looks like. Usually there's a couple grids or several grids in a single county, about 12 by 17 miles. So that's the area where precipitation will be measured. And it's based on weather stations. So the data that's used for it, there's going to be weather stations all over the state, and the information from these weather stations, where nobody knows exactly where they are, which ones they are, but there's a lot of them, and they're going to be used to measure precipitation in each grid. And if you're concerned about how this is measured, you can actually go and look at historical measurements, and I'll get to that shortly. The next part, less precipitation than usual. So it's not about absolute rainfall or absolute precipitation. It's about, is it less than was experienced historically? So if you think, if it's always really dry every summer in your area, and it's just as dry this year, that's not going to be covered. It has to be even drier. So when you talk about precipitation with this insurance product, it's all in relative terms. We don't talk about inches. It's all based on an index that's set at 100. So whatever rain, the historic amount of rainfall is within a 2-month interval. We'll get to those intervals in a minute. Is set to 100. So 100, you can think of it as 100%. That's the normal level of rainfall. So let's say you have an index of 75. That means your rainfall within a 2-month period is 75% of the historic average. So everything in terms of rainfall or precipitation is in relative terms. So here's a table, and this shows the precipitation index, or the actual index for Jefferson County over several 2-month periods from 2020 to 2022. So we're going to get into these numbers in a little bit, but right now I'll come back to the slide. But I want everyone to look, there's 2-month intervals throughout the year. So that's what a producer has to select. When they want coverage, you have to use PRF at a minimum for 4 months out of the year. Use it for the entire year, but you have to use it at a minimum part of the year. Now, this is a decision that, especially if a producer hasn't used PRF, it might take a while to figure out what you want to do. It's something you really have to do some homework, maybe sit down with an agent. It's not a straightforward decision. So, but the important part here is the producer gets to pick when in the year they use PRF. So here's some examples of different times of the year you can use it. In addition to picking when in the year, you also get to pick how important each part of the year is. So this is easiest to show with an example. So let's say you want to cover the spring and the summer. So you're doing the March and April interval, May and June, and July and August. And you're going to give March to April a higher weight, 50%. So that means higher premiums and then higher potential payouts. And then July and August, you're going to give it a lower weight, 10%. Second example, you may just want to cover the winter months. Winter months historically have had higher payouts. There's more volatility and precipitation in the winter. So you could just select the winter months if you wanted, if a producer wanted to. This last example, you could pick, go from January to December. So you're covering all months at an equal rate. So there's different strategies here depending on a producer's objectives and needs. And again, this is something that, especially if a producer is new to this product, you want to sit down and spend some time trying to figure out what works best. So in terms of the rules, 4 months, that's at least 2 2-month intervals. Then you have to, after you select the intervals, you have to weight them. So the weights that sum to 100, and you can't do less than 10% or more than 60% for any individual interval. The importance of these weights, again, it's premiums and indemnity. So if you want more coverage in a particular interval, you give it a higher weight, then you're paying more of a premium. If there's a precipitation shortfall, you'll get a larger indemnity. The payments for PRF are automatic, direct deposit, but these can be made automatically because they're only based on local precipitation shortfalls. So they're made when the actual index in the producer selected interval is lower than the producer selected coverage level. Coverage levels are from 70 to 90%. Like I previously said, a coverage level, if you haven't used crop insurance before, it's a little bit like a deductible. It's the level at which you start getting payments. So if you pick the highest coverage level, 90%, you have to have rainfall be below 90% of the whole historic average to get a payout. You can go as low as 70%. Now, with these coverage levels, you do to some degree get what you pay for. The higher coverage levels cost more and pay out more. They pay out more often, and they're going to pay out a higher amount. For the lower levels, they cost less, and they're going to pay out less. But they'll still provide protection. So if we go back to these, again, this is the table of the intervals. So from January, February to November, December, from 2020 to 2022. And this is the actual index for a grid in Jefferson County, Nebraska. You can fill this online, it's pretty easy to do. And this is only a part of it. You can actually go back 20 years. A lot of insurance agents have their own tools to do this. But it's pretty easy information to get. And you can, anyone can go and they can see what has the precipitation been in their area. So if you look just at 2022 for Jefferson County, I think it's one of the 2 counties in Nebraska that still just only has some part of it that's abnormally dry. Is it officially in a drought? But it was pretty dry in January and February, and through March as well. And then you had average or above average rainfall through at least August. Presumably drier conditions now. So I'd expect some of these intervals to have a lower precipitation index, but those haven't been released yet. One thing's nice about this though, is if a producer has records or sort of remembers historical weather patterns, they can go back and look at them and see if their experience doesn't match that of their grid. So we just looked at some of these are actual indexes, this is actual precipitation levels. So how does it work in terms of payoffs? So we can go row by row. So first of all, what if you picked the highest possible coverage level of 90%? And the actual precipitation index was 85. So in this case, you do get an indemnity. So your coverage level was higher than the actual index. So you get a payout. However, in the same situation, if you picked a coverage level of 80%, the actual index was 85, you don't get a payout because your coverage level is lower than that actual index. This last one, let's say you picked 90%, but your actual index was at 120. So precipitation was 120% of the historic average. It's higher than usual. So no one's going to get a payout under these conditions. It's relatively wet. There's been relatively more precipitation. So there's not that same need for a payout here. So the next step is when you get paid, how much do you get paid? And that's going to be based on an estimate of the value of the pasture for grazing or for the returns to a hay crop. So I just checked our budgets, our K-State budgets that we do, and 2023 returns to alfalfa are $488 per acre. It's just double that of last year. So that's presumably driven by under an assumption of average yields and our current prices that we're seeing. But again, there's going to be, it's based on estimates of the value of the crop or the hay crop or returns to grazing. And this is based on 2 factors. So the USDA makes county level estimates of either average hay returns or returns to grazing, the value of pasture for grazing. And that's going to be an average. So it may seem too high or too low for some producers. So they're allowed to make adjustments to this the underlying value of what's being insured. And so there's technical terms for these. So the first, this county level estimate of the value of producing hay or the value of grazing, that's called the county base value. And that's predetermined. But again, the producer can use that productivity factor to scale that up or down. So within a certain range, you can pick a higher or lower value for your coverage. The intuition behind this is you may have higher land that's higher or lower productivity than the county averages. A producer could also use this to increase or lower their coverage. Say they're concerned about costs or they want to purchase more coverage. So that does add in some flexibility. So how do these payouts get calculated? So first of all, whether or not a payment's triggered. So is actual precipitation lower than your coverage level, and what's the difference between the two? And then there's the county base value, the productivity factor. So what's the shortfall in relative terms? What's the value of being produced, both based on the county base value and the productivity factor that the producer selected? And then it's also going to be weighted by the interval share. So whatever weight the producer assigned to the interval where payouts are triggered, the payments are going to be scaled by that. And that's going to give you an indemnity. So some of these a producer can't control. Actual precipitation, that's why you're insuring in the first place. Also, those county base values are predetermined. But these are the three big choices here: coverage level, productivity factor, and what intervals you use and how important you make each interval or each time of the year. Here's a more detailed formula. I'm going to post the slides later if you want to come back to this and get into some more details. But I do have a quick example that I want to go through here for how PRF is performing in 2022 for hay in Jefferson County, Nebraska. So what I did was I used the USDA tool for a policy that was covered each interval equally throughout the year. So I only show the ones that had been reported yet. There's also September, October, November, December here. So that will add up to 100. So the premium for this policy be $21 per acre. So hay is typically a lot more than grazing. So grazing, you know, when I run policies, $2, $3, $4 to $5, depending on where a producer is. But the protection, the value of hay production is so much higher than grazing. That's why you have this higher premium. So that's what this protection number here is. That's the value, the value of what's being produced. I use a productivity factor of 100. So this 226 is largely reflecting the county base values or USD value. I think they're about 250 for hay for Jefferson County. So this is sort of the, you can think of it as a maximum indemnity that could be paid out. So in this example for 2022, the only time when indemnity would have paid out was January and February. The other months were only a little bit below average, or it was barely being triggered, or in July, August above average. Although again, I wouldn't be surprised if you had indemnities triggered in the fall. Those just aren't reported yet. I have an example here for 2021. I'm not going to go through each interval here. You can do that later if you want, but similar premium and protection for a policy that covered all months, and the indemnity would have been $37 based on low rainfall in the spring as well as in the November, December interval. So historically, the deadline for PRF was November 15th. Now it's December 1st, so that's coming up in a few weeks. So December 1st is where you make the commitment to buy the policy and have all the different characteristics that we talked about selected. The premium is going to be billed on September 1st. So several months later, the premium will be due. So from a management perspective, there's different ways you could look at the PRF, that a producer could look at the PRF decision depending on their priorities. The first is cost, and this can go from $1 per acre for some grazing up to $25 per acre. So it's very customizable. But some producers use that productivity factor to manage the cost. You could also use lower coverage levels, but wide range of costs depending on whether you're covering land for grazing or producing hay, as well as the choices that a producer makes. So it could be used low coverage levels of a low productivity factor for more catastrophic coverage, or a producer could purchase a much higher level of protection. Risk reduction, so that's what, if you want to use it to try to get income to cover shortfalls in feed or shortfalls in forage. So, what times of the year is a producer going to be most vulnerable to precipitation shortfalls? What 2 months intervals are the most critical? And if this is how you're using it, this is really important, because that interval, let's say you picked April, May, or May, June, and you had a lot of rainfall in April. And so the April, May might not trigger, but if you had the May, June, and there was shortfalls in May or June, that could trigger. So if the sort of risk reduction is really important, being very careful about the intervals matters, because it's for the whole 2 month period for the entire grid. Also, again, PRF is not based on what happens on an individual field or farm. So a producer needs to be comfortable with getting payouts based on the experience of the entire grid. So there are cases where producers' precipitation, they're okay in their own fields, they still might get a payout if things are pretty rough for their area. The opposite could also happen. You could be in that part of the grid that has a shortfall, but everyone else does okay, and you might not get a payout. This is less likely to happen in extreme drought conditions, but in a more normal year, it's something that producer needs to be comfortable with. So the other thing you can look at is returns from PRF. So because the federal government is paying for part of the premium, a producer that uses PRF consistently over the long term should come out ahead. There's a couple key words there: long term and should. So there's no guarantee that a producer comes out ahead. It is a typical experience, but it's there's no guarantee of that. If you go through an extended period with lots of rain, it's going to look like insurance, but hopefully that the rain was beneficial to the operation. So that's an important part of understanding how this works. Also, in terms of returns, there's been some studies done on this, and I know a lot of agents recommend it. But if getting indemnities, more regularly is important to a producer, the winter intervals have been paying off more. And this is somewhat backwards looking, but this has been the typical experience, that indemnities have been higher in winter months. This last point, that sort of something we're starting to work on here in K-State, I'm going to be talking about a little bit in the end as I have time, is encouraging producers to think about using PRF as a drought savings account, or that these indemnities could be saved and used to make up for forage shortfalls, or to restock more quickly, depending on what what other kinds of management decisions are being made. But that these payouts, if saved, could go pretty far in helping the producer manage drought, potentially taking a little more risk in terms of higher stocking rates, maybe thinking about buying forage. There's no one thing you could do with it, but thinking about PRF as providing some savings to do whatever is best for an operation to manage drought. So again, from a management perspective, PRF is going to provide protection against general dry conditions. If a producer does it long enough, they're likely to come out ahead. And if it's the first time, there are some areas that hopefully, we've spent some time here going through them, where there's need for working with an agent, doing some homework, some careful consideration is, thinking about, where your grid is. If you have a farm that covers multiple grids, there's some flexibility, and understanding that coverage is for the grid and not for the farm, being comfortable with that aspect of it. Interval selection, so thinking about what times of the year you want to use coverage, and then how much coverage you want, both in terms of when payouts get triggered and how much of a rainfall or precipitation shortfall you have to get a payment, as well as a productivity factor. So what's the value of what's or the size of those indemnities. Right. So I have a couple slides in here on annual forage. It's more for your reference, but this is, sometimes I describe it, it's PRF for annually produced forage crops. And that covers most of it. There's still a rainfall index. You can also use it jointly with MPCI, with the regular crop insurance policy. I haven't seen a lot of interest in Kansas, but this option does exist. It is being used in several states, but at a much lower level than PRF. So in terms of growing silage, if you're grazing wheat, those would be the types of things that you would use this for. There are a few key differences. Again, these are for your reference, but the deadline is going to be July 15th. So higher base values. So it's sort of more. It's going to have provide more coverage based on the value of the crop. The intervals are less flexible, so you have to select your growing season. There's 4 growing seasons throughout the year. These are about 7 months long, so you have to select intervals within a growing season that corresponds to when you would be growing. So it is a little bit different in those ways. There's also some, and this is something where I would just refer someone to an agent, but whether or not annual forage attaches, whether if you intend to grow a forage crop and then you decide to use it for forage or as a cover crop, that can affect how annual forage works. And again, that's something to talk to your crop insurance or livestock insurance agent about. So one of the big questions we're having right now, does PRF pay out during a drought? And to answer this question, I looked at the data from this year. So I looked at current indemnities paid for PRF in Kansas County. So I was looking at how much has PRF for 2020 paid to date. So this is still incomplete. It just shows the payments as of this week. But it can give an idea, are people being paid more when they're experiencing more drought? This is as of November 9th. So right now, I think we have 2 counties in Kansas that are abnormally dry and everything else is moderate drought or worse. So things are really dry. We have 50 counties in exceptional drought, which looks pretty similar to what's happening in Nebraska. But I separated all the counties by drought score, and then I took average indemnities per county per enrolled acre. So this is the average payment. I'm averaging all the counties that falls into each category. So for this first one, moderate drought, 14 counties in moderate drought in Kansas, and their net indemnities were -10 cents. So they have received some indemnities, but not enough to cover their premiums yet. Not too far from that. This covers over 200,000 acres that are enrolled in the program. This next level, severe drought, 23 counties in Kansas, and their net indemnity, average net indemnity, so taking the average across those 23 counties, are 76 cents. So To date, on average, payouts are 76 cents higher than the premiums that have been paid. Extreme drought, we have 18 counties in extreme drought, about 400,000 acres, and they've received average payments of $4.40. So fairly sizable payouts. And then if you get to the 50 counties in exceptional drought, their net indemnities are currently standing at $5.12 per acre, and that covers over 1.5 million acres. So if you look at Kansas for this year and payouts by drought status, you could say at least on average that PRF has been working as intended. Let's see if I have the number here. So I think we have $14 million of producer premiums this year, and we're at about 25 million in terms of indemnity. So probably going to be pretty large loss ratios or pretty large payouts this year when we're experiencing severe drought across the state. I do want to make it clear this is not a perfect comparison. So low precipitation, low rainfall at a particular important point in time is related to drought. It can cause a drought if it, depending on the timing and how extended this period is, but it's not exactly the same as drought. Also, you could have one large precipitation event anytime during an interval that's going to affect the actual index. So it's not a perfect indicator of what's happening on the ground. It's a good indicator. Also, you could have producers could have selected intervals that don't match existing drought conditions. So say, you have producers that selected intervals in spring and summer to cover when they had the most forage risk, forage production risk, but then you had drought occurring in the fall. And so the data might not pick that up. Also, coverage levels, productivity factors, others, whether you're using hay or grazing. There's a lot of things that could affect these numbers, but if you look at the averages, again, PRF does tend to have higher payouts for higher levels of drought. I have some questions. I'll take these. Okay, I'm going to stop now. I wouldn't go through an example, but I'm going to stop and ask some of the questions while it's a good point. Does it matter what kind of hay? No. So that's one question. If you're going to buy from grazing, you have to own the cattle. I know there's some insurance agents on here, but my understanding is no. You can't have double coverage. So let's say you own land that you're renting out. You could cover it with PRF, but your tenant couldn't buy the exact same coverage on top of it. You'd have to share it. Can you use PRF in conjunction with NAP for native grass? I have heard of NAP being used for silage sorghum or forage crops, but I don't think you can use NAP and PRF together. That's not how NAP is intended to be there when PRF's not available. Okay, would premium payout be different? So the formula for premiums and payouts is set by the USDA. So for the same policy, different insurance agent can't charge you something different. They're basically competing on service. And that relationship, if you haven't used insurance before, that relationship with your agent is really important. Finding an agent that you trust, that's experienced, can be very valuable. Okay, someone just answered it. Thank you. That is not correct. You must. Okay. There is a lease certification form. Okay. All right, so we had a clarification on grazing. All right, I'm gonna defer to agents on that one. Okay. All right. Okay. So someone just said NAP and PRF I don't think that NAP and PRF can be used on the same. They can be used by the same producer, but I don't think they could be used on the same piece of ground. That would be an overlap in coverage. If somebody from FSA knows differently, that's something I can follow up on though. Okay, another comment, heard concerns from Sandhills that precipitation does not match what is actually received. Can you comment on collection sites? So I think I do understand that there's a lot of concern about that, where the collection sites are. And that's not the specific collection sites, as far as I know, are publicly reported. I was able to find some data on the density of collection sites and accounting, but that's a frequent complaint that I get, especially, you know, if you're looking at a 2-month interval over an entire grid. That's a pretty common experience. All right.
Can I jump in
Yep.
1 second on that
Yep,
one?
please.
We have heard that a lot out there, and there's definitely more space between the sites. Don't let that be your driving factor. What Jenny said about the savings account is very important, in the sense when you run into PRF in your rainfall, what you're going to find is you may get payments when you don't need them because it rained where you're at, but not rained at the sites, or the opposite. Don't let that drive your participation. Use that to your advantage, to when you get them and you don't need them, maybe then put them away. Save that or invest that into something that could help you be more resilient through a drought. But realize that when a drought does happen, and not a mild drought, like Jennifer said, when it gets really bad, it's very likely to trigger. But know that you may have a drought at your place, but you may not get a payment. But the opposite also occurs, and there's too much on the first one there that well, I had a bad experience and didn't pay. We've also found evidence out there at the Barta brothers and the Goodmanson that it also pays when they didn't need it. So it's got to be some deep thinking on this thing, and going through it over time through multiple years.
Yeah. Yep. Corey, while you're on, I want to follow up on that rental one. I know for sort of standard crop insurance policies, that the coverage can be shared by the landowner and the tenant. And what someone here had said was that if you're a landowner and you rent, that only the tenant could take the coverage, which is a little bit different. And I usually defer to agents from this, but
Same here.
I'm not totally.
Rita is an agent.
Okay. Yep. Then I would. Okay.
She would
Okay.
know quite well
Okay.
what's going on.
Okay. Okay. Yeah, but if anybody wants to provide a clarification in the chat box, or I can check the policy documents afterwards and follow up. But usually every time, okay, I give a talk on crop insurance, there's something like this comes up that an agent can deal with. Okay. All right. So those are all great questions. I got about 10 minutes left. I was going to give an overview of one of the sort of scenarios that the analyses that I have done. And that'll be there. There for reference. And I see the comment from Rita. Okay. Okay, that makes sense. All right. So I'm going to cover this last part. I'm going to go over it fairly quickly, but the slides will be there online. I'm happy to follow up. And this is an area where I've been trying to explore more, not just looking at what are the payouts you get and when you get them, but how can an operation use them to manage through a drought, and how valuable are those payments? So how I've been thinking about this, first, what's the the cost of purchasing hay or purchasing forage for feeders and post-wean cows. How do those numbers compare to PRF and LFP payments? For those that aren't aware, LFP, Livestock Forage Disaster Program, those are for counties that have a high enough level of drought and get payments from the FSA, the disaster program. So complementary to PRF, perhaps some overlap, but they're both available. So these are a little bit numbers from a month or two ago, but we've seen drought extending across the Great Plains in the past several months. Hay prices are increasing at the same time. So this is just from May to September. A lot of producers pay higher prices because these don't always count for transportation. But the big picture here, prices are going up across the board, doubling in Texas within a few months. We've also seen big increases in Kansas. So it can be hard to find hay. And then sometimes when you find it, you're paying a substantial premium. Fortunately, cattle prices have also been high at the same time if you're selling. So first of all, we looked at what if you have a calf and you want to feed it out. So post-wean, you want to take a couple more months to put some pounds on it. Assuming that you're buying everything. So you don't have forage, but could you still make money if you wanted to pay for feed? And so all of our assumptions are on here. I'm not going to go over these. And I would say, for anybody, look at these numbers, not necessarily with a microscope, because conditions are constantly changing, prices tend to be increasing, but it's sort of the relative values we're looking at that are important here. So what we found to feed out a calf through the beginning of 2023, total cost $185 or about $77 per hundredweight, with current prices when we did this being about $177 per hundredweight. So potentially a sizable gross margin there for folks that were considering purchasing forage. But again, we're in a major drought, and we do see, if you look at the past 20 years, hay prices can go up quite a bit per ton. And you could even see prices, say looking at 2011 to 13, when over severe drought, hay prices can even double. So, when prices go up, if you assume it increases in hay and corn prices, here we had that feed cost per hundredweight could go up to $90. I think under prices we're seeing today could be even higher than this. But the comparison to current feeder prices still might be favorable for some producers. What about feeding a post-wean cow? What if you have to supplement? So we came up with an estimate of an extra $125 per cow. And so how do these numbers look if you're using PRF or if you're getting the LFP payments? So, in one of our drier counties in Kansas, Finney County, pretty large net indemnities, both for hay and for grazing in the past 2 years. So $9 an acre in 2021 for grazing, $41 in 2021 for hay, and substantial payments to date as well. So how do these payments compare to current costs? So grazing $9 and $6 per acre net indemnities, but these are the amounts that your feed costs per head are going up in our models. What about a post-wean cow? So we have this number of $125 per head. So PRF grazing payments, if you combine 2021 and 2022, you'd have $15 an acre. It's probably more now, and that could go up to $150, $200 compared to this cost of $125 per head. So similar magnitude, you know, if you've been using PRF consistently and saving those funds, they are comparable to current feed costs. Running short on time, and I do want to take some questions. I might leave. Okay, looks like these are from the rental question. So livestock forage disaster program, that's also been making substantial payments. Those can be made based on your cattle numbers if your county is experiencing sufficiently severe drought conditions. So the net numbers, there's a whole formula for that, but $26 per adult animal per month net payment and $20 for non-adult for a maximum of 5 months, with payments varying from county to county based on the conditions there. Stocking rates can also go into play. So again, if you think about the cost of feeding and posting a cow, $26 per month. If you have the exceptional drought maximum amount, $133. Again, that's comparable to the cost of feeding a cow for a couple of months. So sort of the big point here, these safety net payments, they can add up, especially if you're saving them and participating consistently. However, you know, we keep seeing forage prices going up. They might not totally cover those costs, especially if you just have payments in a single year, which, you know, does get to having that savings account to providing more flexibility with management. And I'm going to stop there, and I'm happy to answer questions or have offline discussions. And I will share those slides. I know I went pretty quick through that last part, but happy to share those estimates.
Brian, can we open it up for some questions?
Yeah, that sounds good. If anybody has questions, please put them in the chat or the Q&A. We have a couple minutes.
I can't see the chat box. Move something. Oh. Here we go. Okay. 9.
So far, I haven't seen anything. No questions, it looks like.
Okay, that's a useful clarification on how leases work. Yeah, depends if it's a share lease or a cash lease. Oh, yeah, let me get you the link for the calculator. I'll put that up right now. There we go. And this, I would say, the PRF calculator is pretty good. I have much less problems with it than I do with the cost estimator for crops. That one could just hang up on me sometimes.
It's
But the PRF ones, and a lot of agents have their own tools as well that work that are nice.
the cost estimator is brutal. Usually got to restart it at least a couple times.
I had my students use the cost estimator ones and stop during class. 10 minutes, it just wasn't.
Exactly. It's
Just one of those,
thinking.
right. Yeah. Sometimes it's fine.
Well, I suppose if they got more questions, Jenny, they can reach out to you.
Yeah, I will save a copy of the slides and share them with you. And I'm also how do I to everyone. Okay. So you can feel free to post the slides. I'll share them with you, and I'm also happy to communicate by email with anybody.
Yes, and for Tiffany there, the recording here today will be on cap.unl.edu. You can go into the webinars and find the recordings. Oh, Ryan just put it right there. Excellent. Well, with that, I'm going to wrap this up. Thank you, everyone, for joining us today. The recording of the webinar will be posted at cap.unl.edu, where you can find and also register for other upcoming webinars. We'd also really appreciate your feedback on the brief evaluation in the link chat there. Please tell us how we went today and any guidance on future webinars. Thanks again for joining us.
Thank you.